Many American investors assume that investing in Saudi Arabia requires living overseas, opening a foreign brokerage account, or navigating complex international regulations. In practice, most exposure to the Saudi stock market by U.S. investors occurs without leaving the United States. This video focuses on how Americans invest in Saudi Arabia without living there, the mechanisms that make this possible, and why indirect exposure is the dominant approach used by institutional and retail investors alike. Direct ownership of individual Saudi stocks by U.S. retail investors is limited. Saudi Arabia regulates foreign participation in its capital markets, and direct access is generally restricted to institutions or approved foreign investors that meet specific regulatory requirements. As a result, most American investors gain exposure through indirect vehicles rather than individual stock selection. The most common of these vehicles is the exchange-traded fund, commonly referred to as an ETF. Saudi-focused ETFs are listed on U.S. stock exchanges and trade during normal U.S. market hours. These funds are structured to hold baskets of Saudi equities and are designed to track the performance of the broader Saudi market or specific segments within it. When an American investor purchases shares of a Saudi-focused ETF, they are not buying individual Saudi stocks directly. Instead, they are buying ownership in a fund that already holds those securities. This structure allows investors to participate in the market while avoiding the operational complexity of foreign brokerage accounts, currency conversions, and local custody arrangements. From a practical standpoint, this approach simplifies access significantly. Investors can use familiar U.S. brokerage platforms, standard tax reporting, and normal settlement processes. For most market participants, this convenience is a key reason indirect exposure is preferred. Another important characteristic of ETF-based exposure is diversification. Rather than relying on a single company, these funds typically hold multiple Saudi equities across several sectors. Energy companies often represent a large portion of holdings, reflecting the country's economic structure, but banking, telecommunications, and infrastructure firms are also commonly included. This diversification reduces company-specific risk and aligns more closely with how institutional investors approach emerging market exposure. Rather than attempting to identify individual winners, the focus is placed on broader economic participation. Liquidity is another advantage of this structure. Because these ETFs trade on U.S. exchanges, investors can enter and exit positions during standard market hours without the liquidity constraints that can exist in smaller foreign markets. However, indirect exposure also introduces limitations that investors should understand clearly. ETF investors do not control individual stock selection, weighting decisions, or rebalancing schedules. Those decisions are made by the fund manager according to a predefined methodology. This means investors must accept the fund's strategy, including sector concentration and exposure levels. For example, energy companies may represent a significant percentage of holdings, which can increase sensitivity to oil price movements. Saudi Arabia's economy remains closely tied to energy markets, and fluctuations in oil prices can influence government revenues, corporate earnings, and overall market sentiment. While diversification within the fund reduces single company risk, it does not eliminate macroeconomic exposure. Government involvement in the economy is another important consideration. State participation can provide stability during periods of stress, but it can also introduce policy-driven outcomes that differ from market-driven dynamics commonly seen in Western economies. Currency risk, however, is relatively limited compared to many emerging markets. The Saudi riyal is pegged to the US dollar, which reduces exchange rate volatility for American investors. This peg provides stability but also limits the potential for currency-driven gains. From a portfolio construction perspective, Saudi exposure is generally viewed as a complementary allocation rather than a core holding. Investors often use it to diversify geographically, gain exposure to energy-linked economies, or enhance dividend income potential. This approach aligns with how professional asset managers integrate emerging market exposure. Rather than making concentrated bets, positions are sized appropriately within a broader global allocation framework. For American investors, the key takeaway is that access to Saudi markets does not require relocation or specialized accounts. Exposure is achieved through regulated, familiar investment vehicles that fit within existing portfolio structures. As with any international investment, proper due diligence and risk awareness are essential. Market structure, government policy, and sector concentration all play meaningful roles in performance outcomes. This content is provided for educational purposes only and does not constitute financial advice. For a deeper breakdown of access mechanisms, sector exposure, and portfolio considerations. Download the full Saudi market guide linked in the description.